I think more so than tariffs, what's really driving a lot of what we're seeing in stock markets right now is uncertainty, right? Markets, they don't like surprises. Business rooms across the country, they don't like surprises either. They're trying to scramble, figuring out what do we do with this? And
Yeah.
so spending some time to kind of unpack what happens next, how we adapt to it, I think that'd be a great place to spend some time.
Hey, Nick.
Scott, how you doing?
I'm doing great. Markets aren't as great, but I'm good.
Yeah, lots changed since we last recorded our most recent episodes. So.
I know. I went away for spring break and came back to Liberation Day.
Indeed. Sounds like we got some things to unpack today.
Absolutely. My thought is let's get everyone caught up on what's going on in the markets. And then let's talk through some frames and principles that people can use at home to make pragmatic decisions with their investments in a turbulent time.
There's a lot of information going around right now, and understanding what it means, then what it means to you and what you do with it. I think that's a great way to go today. So,
yeah. So,
what are tariffs?
Yeah, tariffs. Tariffs at the end of the day for everyone who does or doesn't know, they're really a form of taxation. It's simply a form of taxation that rather than being pinpointed to us based on our income is taxed to other countries bringing in goods. And those goods are then either going to go up in price for us to consume them. So we will pay more for those goods due to the tariff, or the company will choose to find a way to eat the cost of those tariffs to not raise the price. Those are kind of the two extremes. And then there's everything in between.
Right.
And typically it ends up being in between. So typically we end up paying a little bit more and the profitability of those companies goes down. It was a bit of shock and awe probably on Wall Street last week. I think the expectation was there was going to be some reciprocal tariffs. Tariffs around the United States, we were giving out a tariff or making other people pay a tariff of about 2.3% across all goods. Other countries were making us pay across all goods about 4.8%. So if you did a reciprocal tariff across everything, it would go up on average about 2.5. That wouldn't be such a huge deal. But we got something else.
We did. We got a lot bigger number. We got 10. And, I think more so than tariffs, what's really driving a lot of what we're seeing in stock markets right now is uncertainty, right? Markets, they don't like surprises. Business rooms across the country, they don't like surprises either. They're trying to scramble, figuring out what do we do with this? And so spending some time to kind of unpack what happens next, how we adapt to it, I think that'd be a great place to spend some time.
Yeah, and to your point, that's exactly the issue. So anytime that you hear something being talked about on the news, whatever news source you listen to, anytime you hear friends at a barbecue talking about some topic, that information is already priced in to the market. The issue with the drop that we had in markets coming out with what President Trump's calling Liberation Day is the average market consensus was he was going to raise tariffs, but it wasn't going to be largely to the numbers that he's posting, right? So the average consensus was a lot less than what happened. And that's the uncertainty that roiled markets, because all of a sudden the price of some Jordans coming from Vietnam went up dramatically. The price of grapes coming from Chile went up dramatically. And you either have to have, to our point earlier, the consumer pay it or the profitability of the company has to go down. And you have both things trying to be understood in markets. And that's what caused this big move down in markets. It's normally not normally we can't tell you what caused a move in markets. This time, I think we can.
This one, it was pretty clear, right?
Like, normally there's a lot more factors than just one thing, but this is a very clear thing. And the way that we went about calculating what we're going to have people pay, it's essentially not so much about trade balances on, hey, you're not fairly letting us sell cell phones in your country versus we get to sell cell phones in your country at a zero trade imbalance. Instead, it's, hey, Canada, you have 41 million people and we have 330 million people. So you have 12% of the people that we have. But to be fair, we should have to zero out our trade every day. And it's like, that just doesn't make sense at the end of the day, because they automatically have, we have 80%, more than 80% more people than they do. So if we're going to trade with them and they're going to manufacture for us, they're going to send way more stuff to us than we're going to send back to them. It's that's just simple math.
Right. And, when we break it down even further, they have a lot more trees than us. We rely on their timber, right?
Yes.
Or when we start looking at what we refer to in basic economics as a competitive advantage, there's things that are just cost effective wise doesn't make sense for us to spend our time, our labor, our energy producing where we can get it elsewhere, and it doesn't have to be equal, right? We can all benefit through this idea of trading with one another.
100%. And you can actually bring it down to your individual level. So like I have a huge trade deficit with my grocery store. I go buy groceries there with money, but I don't expect them to buy anything from me, right? Yep. And then most of us, our employer we have a huge surplus with our employer because we trade our labor for money. Mm-hmm. So it's kind of a little wonky to talk about this, but it's important to talk about this because trying to get everyone to balance out just doesn't make sense in the world. It will never make sense in the world. Mm-hmm. But because of that, we have some issues to deal with. The market's roiled. And we have to figure out how to help you listeners at home deal with that.
There's a lot to unpack there. And I think, looking at what's happened in markets, oftentimes what we hear on headlines news, right, wherever we get our sources, it's a lot, right? Oftentimes we'll tell our clients, hey, turn off the news, go for a walk, hug your loved one, get away from it for a while. And I think it'd be wise just to kind of go through understanding what we see or what we absorb with headlines news oftentimes doesn't always resemble what's happening in our portfolio, because the market's a lot more than maybe the S&P 500 or the NASDAQ or a few big stocks that we're hearing about that are moving quite quickly.
Oh, absolutely. I think that's such a valid point. And so to that end, I'm just going to briefly share on our screen where the global market stood at the beginning of this year. So the United States stock market, so really there's 3,400 companies in the US stock market that comprise $61 trillion and 65% of the world's market capitalization. So if you said, I want to invest in everything around the globe, 65% of your money's in the US. The developed markets, there's about 6,300 companies, about $22 trillion, 23% market capitalization. And then emerging markets, so developed markets are like Canada, the UK, Japan, Europe, Australia. Yep. Then emerging markets, that's going to be China, Korea, Taiwan, India, Brazil. Mm-hmm. About 10,000 companies, $11 trillion, 11% market capitalization. But so you can see you're going to hear in the news what's happening in the S&P 500 or the Dow Jones Industrial Average, more than likely. Mm-hmm. But you're not hearing about what's happening around the rest of the world. And I guess my question to you is, for the listener at home, like if you felt like something's going bad for the US, what do you think is going to be happening for the rest of the world? And I think for most of us, I don't know about you, Nick, but I think for most of us, we go, well, if it's happening, if it's bad for the US, it's got to be really bad for everywhere else.
Right? It's got to be. Right. And so what's really interesting, though, is we didn't see that. Actually, pre-Liberation Day, right, when we had more news about Mexico and Canada, we had markets moving in opposite directions. We had this bad news at home, but what it also created was opportunities for different countries to say, you know what, I think we may bring some more work back in domestically back onto our own soil. And what we saw was international markets positive on the year. Same with EM. Things changed a little bit, but what this chart suggests here is there's some disparity. It's not all perfectly correlated. They're not all down the same together. So things move in different directions.
Yeah, exactly. So like to your point, when the U.S. was down and we were worried about it before Liberation Day, the emerging markets and the developed markets were actually in positive territory fairly nicely before that happened. And even now, even into today, the U.S. is now down. The U.S. market as of today, I don't know what it's doing today, but going into this morning was down 15.5% for the Russell 3000 total return. And then the emerging markets were down 6% and the developed markets were down 1.3%.
That's it.
So if you're invested in all of those, you're going to be a blend of those things. You're not going to be all one thing. And then the other thing is most clients, especially if you're near retired or are retired, you're going to have a bond portfolio to help sustain you and be a ballast for you during these downward times. The U.S. Bloomberg Aggregate Index is about 2% so far this year. So a blended allocation, we just pulled one up to look at it from a kind of have a picture of it. If you were invested 60% stocks, 40% in bonds globally, is going to be somewhere around down 7. It's not down 15, right? So it's not as dire as you think, as it may feel if you're listening to the news.
That makes me feel a lot better.
It makes me feel a lot better too. That's why we build portfolios that way when you're near retirement, right? You need portfolios. You need to have ballast in your investment accounts to be able to draw from while you give yourself time and space for the markets to come back up. Where do the markets go from here? I think we are never like to be predictors of markets, but I don't know what will actually happen, but I think that it's going to be dependent upon what the Trump administration does. Do they mean to have these tariffs be in place for the foreseeable future, in a sense, forever? If that's the case, it leads to one direction that does not look very positive for the markets overall, because you're basically telling the markets to completely rebuild the system. And that will be extremely painful. No doubt. You can just go look at Ferris Bueller's Day Off when we're talking about the Smoot-Hawley tariffs and how that took the depression from a depression into a deeper depression, right? Tariffs are painful not only for the countries you impose them on, but for the people at home as well. If it's used for a negotiation tactic to reduce tariffs overall, it could turn out to be something positive. We just don't know where it's going to play out.
Yep. Again, going back to our big word, uncertainty, right? And just not knowing where that's ahead. But, when I see the slide, it tells me diversification's working.
Absolutely.
When we go back just a short few months ago, no one wanted to be diversified. We had equity markets in the U.S. that coming off back-to-back years of over 20%, things were great. Why would I ever own anything other than the S&P? And now,
I just want to own the Mag 7. Let's go. Yeah. Yeah, no, not so much anymore.
Right.
But then if we go there, the other thing to remember now, this one is I don't want to say this was brought upon by really one person, this downturn specifically, but downturns happen all the time in markets.
Mm-hmm. What are we looking at here? I see different color bars, but then I also see red dots.
Yep. So what this is looking at, what we're looking at is, and if you're just listening at home, right, we're basically looking at the idea of, hey, if we think about the Russell 3000, so the 3,000 stocks in the U.S., what's their average return? So that's the bars up at the top, the solid bars. And then there's a little dot that's basically what's the biggest drawdown, intra-year drawdown at any one year. And so in 2005, a 6% positive return for the year, but the max drawdown was 7%, so minus 7. In last year, up 24%. The largest drawdown was 9%. Then, of course, there's the 2008 crisis. We were down 49% at the max drawdown with down 37 for the year. The key is if we average all of those across the board, you get an average drawdown of about 14%. And so the point is that market drawdowns, meaning entering a drawdown or even a correction of 10 to 20%, they happen fairly often. But because we've had positive returns for the last couple of years, we really don't think about that.
Yeah, and when I look at this, it reminds me of like where we start isn't necessarily where we're going to finish, right? If I go back to 2020 and it seemed like so many different things going on, but specifically within stock markets back in March, it's like, are we ever going to make it to December? What is the light at the end of the tunnel? Is there a silver lining here? And when I look at this, hard to believe back in March that you would tell me that we finished the year at positive, 21%? That's wild. And so,
Right.
when we talk about uncertainty, I think just as quickly as these tariffs came on, they could also come right on off. And so markets could surprise to the upside. And I think what's really interesting, and I don't have a chart on this, but volatility tends to be clustered together. In
Absolutely.
other words, like we can't have the bad days without the good days and vice versa. And so this is why we don't try and time markets, because if we go back to 08 or 2020, or even kind of what we're beginning to see now, is markets move in big directions to the upside and the downside really, really quickly.
Absolutely. I couldn't agree more. We do see it time and again, which is why we don't market time. You don't market time because you have to be right twice. You have to get out ahead of time, which no one did for this that I'm aware of. Right? No one knew Liberation Day was going to be so exciting. And then you have to get back in before the big up days come. And to your point, the up days and the down days are almost always clustered together. So you need to remain invested through that 100%. And that actually just leads to the next idea, which is that you see long-term gains happen because you're willing to stomach these short-term down periods. The down periods, though, we inherently as human beings, we feel twice as much pain losing $1 as we do gaining $1. And that just comes back to the way we're wired to survive in our lifetimes. So when you look, you just have to recognize that with yourself and learn, try to be at ease with that idea.
Yeah, it's really interesting. I put this in a newsletter the other day, prior to, I think, the last couple of day drawdown. I want to say on Friday we closed back to where we were in September of October of last year,
right?
Which still pulls forward 1 to 2 years of incredible growth. But to your point, I don't like to lose money. It's emotional. We get anchored sometimes to logging in and seeing a balance and saying, wow, that feels really good. Right? And it stings. But when we zoom out, we've done really, really well. And so, Morgan Housel has this great quote: volatility is the price of admission. Otherwise, we're going to keep our money under a mattress. And we're going to have those bumps and bruises along the way. The trick is, can we hold to it? Do we know what our plan is? And can we see through these times to come out on the other side?
Which is a great pivot to what can we do, right? So knowing that you're going through this down period, knowing that this is happening for you, what can you do? And I think the frame I'll give is the thing that we look at with clients consistently is, of course, it's the first thing is, do you have the right asset allocation? Right? Meaning how much do you have in stocks versus bonds? This isn't necessarily the time to change that, but it's a great time to get a sense of how does it feel for you to be invested the way that you are. And then once you know that, you need to just go look at, well, based on the way that we invest, should we be doing anything? The way that we look at should we be doing anything is we use what we call we call them tolerance bands for the way that we invest. So the simplest example I'll give you is emerging markets. For most of our clients is around 10%. And I'll just give 10% because it's an easy number.
Nice round number.
Well, on the equity side of things, we really want to give a tolerance movement in a equity position of 20% either direction. So I will let it go from 10% up to 12 or down to 8, right? So it's 2% either way. And so what will happen is if we go monitor the markets and emerging markets dips under 8, we're going to sell some of our bond portfolio, which you've just seen is fairly stable right now. And we're going to go buy another 2% or ish back up to 10% of emerging markets. We're going to choose to buy something that's low at the time, right? But we have a mechanism in place to make that decision. We are not making that decision based on emotion.
Right. And I think it's so important that, for clients and for listeners hearing this, like we had this plan in place beforehand, right? Yes. Now is the time that we get the opportunity to go back to our plan and say, okay, let's open the instruction manual. What does it say about market volatility? Well, stick to the plan. We have this in place ahead of time. And I think to your guardrails point, what's so interesting too is it works on the other side. So when markets were fantastic for the last 2 years, guess what? They probably drifted to the higher side, which then said, okay, we have too much of this. Let's go put it to work in other areas.
Yep, exactly.
And so, yeah, clients will come to us all the time and say, okay, what are we going to do about it? And it's twofold. One, we'll say, okay, well, what's changed in your life? Nothing. Well, the world around us has changed, but specifically, are you still working? Do we still have time to contribute to our portfolios? What around us has actually changed circumstantially? And if it's nothing, well, this is why we have a plan in place.
Yeah, no, absolutely. And I think that it's really two sets of clients treated a little differently.
Mm-hmm.
If you are retired, you're worried. Am I going to be okay? That's why we use things like, I think we've talked about it before on the show, a withdrawal rate strategy, whether it's the 4% rule, which is very crude, or Guyton's guardrails, which is a bit more nuanced. And then you're monitoring that relative to portfolio values to make choices on how much are you taking from the portfolio to make sure it's available to you for over 30 years. If you're young and this downturn's occurring, this is actually not a time to be fearful. It's a time to get excited because you get to contribute more money with every paycheck that goes into the 401k. You're buying more shares than you were before, right?
And I think on that point too, if you're younger, looking at this as a buying opportunity, I don't want you to get so lost in the weeds of I have to perfectly time the bottom. Warren Buffett has this great quote where he says, I didn't know timing back in 2008, but I knew price. And price was telling me this is a buying opportunity. And so where we look at where things are priced today, if you have what I like to refer to as that dry powder on the sidelines, go ahead and put it into action, right? Again, this comes back to our basic framework of let's not go deplete our emergency savings to go do it, but we're looking at maybe increasing our 401k contribution. If we're someone who maxes out our retirement savings, whether it is the 401k or the IRA, maybe instead of spacing it out over the entire year, we pull forward a couple months worth of contributions. Because again, to your point, Scott, we're buying shares. We're not buying a price. We're buying the shares.
Yes, you're an accumulator of shares. That's how you get wealthy. Because the price is going to continuously change. Yep. Yeah, absolutely. Yeah, I think that's a good framework for today. Well, I hope that's helpful for you folks at home. And if you have any questions, give us a shout. Feel free to submit a question by looking at the link below wherever you listen to the podcast. We'd love to hear from you and help you.
That's what we're here for.
Talk to you guys next time.